Welcome to Startup Sim. In this tutorial, we will discuss the consolidation process. The consolidation process is a very important information for shareholders. It applies to the balance sheet and to the income statement. In this particular tutorial, we will discuss the consolidation of the balance sheet. This is an element of the balance sheet that's particularly relevant to shareholders because shareholders are interested in how well your company performs overall. There are details in the different areas in which you are invested, but the shareholder wants to have an overview. And this is what the consolidation is all about. The consolidation is like the total view of your company. And in order to get an overall view of the economics of your company, you need to sort of agglomerate the different bits and pieces that you have in the USA, in Europe, possibly in Brazil, and also in the home office. So the last column of your balance sheet provides you with this consolidated view of your balance sheet. We will first look at the assets and then liabilities and equities. But in a nutshell, each and every line that is relevant to each of the areas and business units will be taken into account. For instance, the consolidated view of the cash is the sum of all cash kept in the different bank accounts of the company. In this case, there is only cash in the home office. Therefore, the consolidation is just the number of Swiss francs identified in the bank account of the company. You will have a consolidated account receivable, which is the sum of the account receivable in the United States and in Europe, but converted into Swiss francs at the rate of exchange of this particular quarter, which here is quarter 8. Then, of course, because there is account receivable in period 10, there is also a consolidation figure for these amounts. Then the consolidation of the inventory is only for the total, because of course we don't need the details at this point in the different products. You have a consolidated view of the money invested in securities, in this case dollars, euros, and Swiss francs. Then the consolidated current assets. Net plant and equipment is the consolidation of the different things in Europe and the US. And then there is no intercompany loan, otherwise it would be consolidated, but only, of course, from the standpoint of the home office. Subsidiary control is not consolidated. Why? Because this is cancelled out in the home office control at the bottom of the balance sheet, because this figure, 16.5 million Swiss francs, is actually the exact counterpart of these equities present in the US and in Europe, or I should say was at the time of the investment, because there could be fluctuations in currencies afterwards. Therefore, here we have covered the list of assets. The same goes for liabilities. You have this algebraic sum at the current exchange rate for the different items in the liability. When we get to equity, it's a little bit more complicated because there are some elements that only are present in the home office. That's the case, of course, of the um, common stock, the initial equity that was given to your company by investors. There is also an additional, if you want, equity, which comes in the form of something called paid-in capital, which is additional investment made by shareholders when they receive dividends. Shareholders like to receive dividends, and sometimes they return some of this dividend in the form of a further investment into the company. Then we have a consolidated view of retained earnings. This is the sum, again algebraic sum, of the positive and negative retained earnings. This figure, for instance, over 24 million, is of utmost importance for shareholders because that's what your company has created in terms of value since the beginning of the simulation. The bulk of it comes from the US and Europe, but of course there is a loss in the home office because the home office tends to have very limited income, but rather it has a lot of expenses like R&D and market research. But that's not a great issue in the eyes of the shareholder because this is more than compensated by the profits made in the other areas. Home office control, as we said, is cancelled out with the subsidiary control at the bottom of the total assets. Then comes unrealized gain. Unrealized gains are, as I alluded to earlier, the effect of currency fluctuations. When the home office buys a currency, be it for instance dollar, if the dollar rises in value, that will create like a profit, which is accounted for here, but it is unrealized until these dollars will be sold and converted back into Swiss francs. So that's only potential until that conversion will take place. And then we have, of course, total equity and total liability and equity that, of course, equals the total assets because the balance has to be balanced.